go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. My guest today, Patrick Wright. He's the founder of Wright Capital Partners. Patrick, how are you? Welcome to the pod.
Thank you very much. How are you?
I can see the weather is completely different. There's a whole north-south divide going on here. You are sitting in summer slacks and I'm all freezing almost to death here. It must be nice, that side of the world at the moment.
Yeah, it's quite hot, but it is nice. I live in the Swiss Alps, so there's no air conditioning, but it's a little bit on the hotter side at the moment.
We got introduced through a mutual friend via LinkedIn, and she suggested to me, said, Patrick is an interesting person. I think you should talk to him. And then we set up a call, and we talked a bit back and through. And I realized, you've got a really unique background in the sense of you spent 20 plus years in the finance industry, covering multiple countries, multinational. And then now all of a sudden, here you pop out like 2 years ago. I think you're doing your own thing. You completely decided to go private, to go it alone.
Yeah, so I basically took what had previously been my hobby, which is, I've always had a very keen interest in financial markets and stocks, and read a lot about different types of investors and their methodologies, and was investing my own money and that of some friends and family for some time, and basically a couple of years ago I decided to quit my previous career in finance and to kind of go full time. So that's what I've been doing since 2020. And
your passion or your market philosophy is that correct if I'm saying it's focused on value investing?
Yeah, I mean, I do. So I have a core portfolio of stocks, mostly US listed stocks. So these are, it's about probably somewhere between 8 and 12 different names. And then I also trade currencies and futures, but the core focus is the stock portfolio, which, I started out learning about Warren Buffett and people like that and his philosophy. And I think that's a very, at least, if you're going to trade in and there's different ways of making money in the stock market, but I think people should at least know what value investing is, because at the end of the day, you're trading not just pieces of paper, but fractional ownership of real companies that create real profits and revenue. And it's important to understand, the value that those profits and revenue streams create.
So this is where I see value investing coming in again, because if we had this pod last year or a year before, people would probably laugh, right? Because that was the period of growth stocks, and no one even knew what value investing was. They're finding out now that if I buy a stock and hold it, just doesn't go up 10 times like a Tesla or something like that. What for someone new that maybe lost a lot of money in the market chasing growth stocks? What is the definition of the pure technical definition of value investing, and what is your sort of outlook on it?
So I think there's different ways of doing it, and people will have different opinions. I really like the way Warren Buffett looks at it, and of course he's been investing for over 50 years, and it's quite incredible for someone to have started with nothing and become the richest man in the world by hundreds or thousands of different individual decisions. And so clearly it's a way of, it does work in making money. And I think if you look at how Warren Buffett looks at it, he's basically, you can kind of think of it as, a company being like a savings account with a certain return every year. And then, he's looking for those companies that have the highest internal rate of return. And if he finds it at a good price, then he tries to hold it forever because it's so rare. And I think that is this case for any kind of investing. I mean, even if you talk to like a bond trader or a currency trader or even someone, trading Bitcoin,
Yeah.
If you told them, where did you make the most money? People, there's certain opportunities and trades and certain investments where they will make a majority of the money. And so being disciplined and I think is also important, but it's the same for anything basically.
Okay, we've gone over sort of why it works, and it's important where you said the 50-year time horizon, because it's a recurring theme on this season where I pick up not guests but market commentators are conflating trading with investing. They're using trading terminology when they want to talk about investing, and they're using investing terminology when they want to talk about trading. Let's say we're talking about investing and they're talking about, you need to buy this dip. That's predominantly something that we're talking in trading. And just to hear you saying, Buffett's talking about a 50-year time horizon. This isn't like next year or the next 5 years. This is generational.
Yeah, it's making money over a long period of time, but I think also people underestimate. People think, well, he's only, I bought Bitcoin at X, or I bought this at Y, and I doubled my money in a year. People underestimate how much money, the best investments that he's ever made are so profitable. And so one of them, that he talks about a lot is a company called See's Candy, which he bought in sometime in the 1950s. So if you're not American, it's a candy company. They make these heart-shaped, Valentine's gifts that people give. And he bought the business in the 50s for $25 million.
Wow, that's
and
a lot of money.
At the time, it had $5 million of profits and $25 million of revenue. And since then, because of course he bought the whole thing.
Yeah.
Whenever the profit has been growing, and now makes almost $100 million in profits. And he's taken out almost $2 billion in dividends. And so, from a $25 million investment, and you could say, he paid $1 billion for Coca-Cola, which is now worth $10 billion. So a lot of, it's hard to know exactly what he spent the money on, but if you keep making these investments that are really profitable, it becomes this money-making machine that just spits out a huge amount of cash flow. And that I think people underestimate the impact of making a lot of money or having a high return over a long period of time.
What are some of the counter arguments against value investing? Because it's not just win-win, right?
No, it's not. I mean, it obviously doesn't work all the time. And that's one of the reasons why it works over time is, if it always worked, everyone would be doing it and then it wouldn't work.
Yeah.
And I think that's the same for any type of investing. You have certain periods of time that lend itself to that style or that kind of focus. And of course, I think some people think that if you're a value investor, you can only buy, these old kind of industries that might be going out of business, like coal companies or banks or oil companies. You can be a value investor and buy Google. Probably almost every stock. There's a bunch of stocks in the stock market that don't make any money. A bunch of companies in the stock market that don't make any money where, unless you thought that they were going to change in the near future, you wouldn't want to buy them.
Yes.
But if you forget about those, the rest of the stocks, you could buy all of them. It's just a matter, are you getting a good price? And so as a value investor, you're really looking at, first of all, is it a good business?
Okay.
And second of all, am I buying it at a fair price?
Good business, fair price. Because I was about to ask you now tips for retail investors that, first of all, where can they go and read up on value investing? What do you consider to be the Bible of value investing? Book literature, books, resources, anything like that?
Yeah, so I would say there's a book called Snowball, which is also kind of entertaining. It's a biography about Warren Buffett.
Okay.
It's kind of long, but it's not just a technical book.
Yes.
So that's that could be a start. Then there's a very Ben Graham and Dodd. Graham and Dodd, they wrote the textbook on value investing. Okay. Back in the 40s, I think. So that's an interesting book. And then there's, Warren Buffett, especially in the beginning, he started out what he called the Buffett partnership in the 60s, where he was like 25 years old, and he would go to his people he knew and he'd say, listen, I'm starting an investing partnership. Are you interested in joining me? And then he would send people, his investors, a letter once a year. So you can read those letters. There's actually a very funny story. There was a guy who was his neighbor, and he said, this young guy came to me and he asked me if I wanted to invest money with him. And I said, no, the guy never goes to work. He's always at home, and he looks like he's like 15 years old. And the funny thing is, like 40 years later, they apparently still live in the same place. Warren Buffett became the largest shareholder of Coca-Cola, and the guy became the president of Coca-Cola. That's kind of a very funny story. But
that's an amazing story. You said look for the pillars of value investing for a novice retail or someone that's looking to buy would be what exactly?
So in terms of methodology?
Yeah.
So the key point is, if you're buying an apartment, you would say, okay, I'm paying $500,000 for it. I can rent it out for $1,000 a month. Mm-hmm. I've got these expenses. I got a mortgage. That's how you would, and then you would think, okay, is it worth my time, to do all the renting and all this kind of stuff? Mm-hmm. Given that I'm going to make a profit of X. And that's really how, if you're buying a stock, there's no effort, there's no work involved, but that's kind of what you would be thinking about.
Yes.
And so you would look at, the income statement. Obviously you need to know something about accounting, but you look at the income statement, the balance sheet, and the cash flow, and you say, well, if I could own the entire business, mm-hmm. is this a good business to own? And I think so there's two parts to it. One is, I think the key part is looking at the return on equity or the return on assets, mm-hmm. Which is kind of the internal rate of return of the business. And I think Warren Buffett would look at it almost like a bond. So if you could buy a bond with a 5% coupon, with a bond, the coupon and the time horizon, mm-hmm. and the price. Mm-hmm. With a company, you don't know the coupon, you don't know the rate of return. You have to calculate it yourself, and you have to calculate the price. But it's kind of the same thinking. It's where you have maybe two bonds. Let's say you have one bond with a 5% return, the other one with a 10%. Which one is better? Well, it depends on the price and the time horizon.
Yeah. Do you think that value investing will inevitably make a comeback? Not necessarily that it was gone, but that it would become more fashionable again as we see, the outpour out of tech and crypto and more highly speculative assets.
Yeah, I definitely think so, especially within the stock market, because at the end of the day, the revenue stream from the company is what underpins the stock, right? And so you see a lot of companies like, for instance, Uber and Lyft have never made a profit. That doesn't mean that they never can. But clearly there's something wrong with the business model if after 10 years they're still not profitable, right? I think they need to raise prices personally, but I'm not an expert, right? But there's something that isn't working correctly.
1 and 1 isn't 2 there. Yeah, I agree with you.
And the thing is, in the past, they always raised money from investors to fill the losses they keep making. Eventually, that's not going to work anymore. And so then you get to the kind of a hard stop where you either go bankrupt or you fix your business model and make money. It's kind of that simple. And, you see a lot of these growth stocks that in the past were just focused on sales growth, mm-hmm. and never really were profitable. And as long as investors didn't care and people were buying these companies and the stock prices kept going up, there was no incentives for the management to change. But now we're in a different environment, and so, I think those issues are going to be much more at the forefront.
Patrick, thank you so much for joining me today. Before I let you leave, just one final question, and a question from Twitter. You spent a lot of time in Europe and in the US in terms of, in the financial markets and sort of the inner workings of it all. What are some of the key differences If you just look at a retrospective look on your 20 years in the industry between Europe and America?
Yeah, so I think the US is much more, I mean, and this is for not just in financial markets, but for everything. It's much more, it's a homogeneous country. I mean, everyone speaks the same language. You have the same rules and regulations. The SEC has these filings that you need to make, like a 10Q and a 10K, which is quarterly and annual financials. So everything is the same. I mean, you look at an American company, they have the same reporting and the same documents, and they're in the same format.
Yes.
Whereas if you look at Europe, it's a much more fragmented market. I mean, an Italian company might only report once a year, twice a year. It's in Italian. It's a different format than an English company, which is different from a German company. And you really need to understand, if you're investing in Europe, you really need to understand the cultures and the language. I mean, it's possible, of course, to invest in a Spanish company without speaking Spanish, but you're at a disadvantage.
Because you're missing the nuances, right?
Yeah, I mean, if it's like Zara, which is a global company, you're probably not missing all that many nuances. But if you're investing in more of a local company, that's something that you need to understand. Yeah, no, exactly. Yeah, exactly.
Do you mind taking a question from Twitter?
No, go ahead.
Because I know you don't spend time there, but FinTwit wants to know, and they saw Switzerland, and inevitably the question came, will Credit Suisse still be in business next year? I think it was sort of tongue-in-cheek. I don't think anyone expects them to default, so that's not really my question. My question is, will they sort of lower their exposure to US equities?
Yeah, so I think actually the European banks, I think as a group, is an interesting sector at the moment because they've been so beaten down. And Credit Suisse is probably the worst of the worst. I mean, it's the Deutsche Bank of a couple of years ago. And if you look at the business, they have a profitable
the Deutsche Bank.
Well, but I mean, a couple of years ago, Deutsche Bank had a.
I was not expecting you to say that. So it's.
Yeah, no, it's taken over the mantle from like the worst bank in Europe. But the core, and this is the thing with banking, is it's actually kind of a boring business, which is quite profitable.
Yeah.
But what happens is, banks become profitable, and then management says, well, we made $5 billion last year. Maybe we should go and, do something with it. And they start doing stuff that is not in their core business, and that's how they get in trouble.
Like investing into the metaverse, for example.
Yeah, for example.
Patrick, thank you so much for joining me today. If the listeners want to go connect with you and find out more about your company, where can they do that?
Yeah, so they can go to my website, wrightcapitalpartners.com, and there's a contact form there. Otherwise, I'm also on Twitter occasionally, so they can look for me there as well.
And connect with Patrick on LinkedIn as well. We'll leave all the details in the episode below. Patrick, thank you so much for joining me today. To our listeners, peace, love, and prosperity. And we'll catch you in the next one. Cheers.